Hi, I'm Richard Vague with Tycos. This week, we're going to compare China and Japan by comparing their interest rates. You may recall that in the period leading to the late 1980s, Japan was growing at a near double-digit rate and many believed was poised to take economic leadership of the world. Instead, in a slow-motion collapse that necessitated government rescue of its banking system in 1998, Japan's growth fell to zero and stayed at zero for the next 20 years, and its interest rates fell to zero as well. What was viewed as Japan's powerhouse growth was instead real estate lending run amok. It has taken a generation for Japan to get past that economic wreckage, and only recently has its economy begun percolating a bit. We expect China to follow essentially that pattern. It was growing at over 10% in the mid-2000s. That has already plunged to 5% and looks to go down further, though China is bravely trying to prop up its growth by any and every means possible. We see evidence of the diverging recent trends in these two countries in their interest rates. The interest rate on a country's 10-year government bond is widely viewed as an indicator of its longer economic growth prospects, a very imperfect indicator, nevertheless something that is widely used as a clue. In the U.S., whenever we have seen the 10-year rate drop, especially if it drops below short-term rates, something investors call an inverted yield curve, that has most often been an indicator of coming economic softness. So let's look at China and Japan's 10-year rates since 2017, noting as an aside that both countries are now suffering population declines. Here we see something surprising to China boosters, since China has long been viewed as a growth juggernaut and Japan as a growth basket case. Here's the surprise. China's 10-year bond has declined in yield to 1.7%, while Japan's has climbed to 1.1%. In 2017, China's was 3.9%, and Japan's was 0%. 10 years ago, and for some even more recently, something like this would have been inconceivable. Believe me, I know. In the spring of 2015, I was in a debate in Washington, D.C., pitted against not one, but four notable economists and officials who were unreservedly bullish on China, who all made the argument that China was different, while I argued that China's businesses were overloaded with debt and the economy had to slow. I told my wife after that debate that I'd made a fool of myself, but, wouldn't you know, China's stock market crashed 1 month later in June of 2015, losing a third of its value in a month, and has had mounting troubles ever since. Now, looking at the chart, you can see Japan's interest rate is still very low, but it has been inching up, indicating that at long last, markets are expecting at least some growth. And China's interest rate has been plummeting, reflecting the sentiment that China's growth is expected to continue slowly. A similar pattern holds for short-term rates of both countries, which are generally more volatile and thus less widely used as an indicator of long-term trends. China's rate has plunged to 1.7%, while Japan's 90-day Treasury rate has inched up to 0.6%. Let's finish by adding U.S. rates to both charts, where you see those rates have increased to 4.4% and 4.2% respectively. To a certain extent, those rates, at least the short-term one, are a reflection of wariness regarding inflation. But they are both now well above the roughly 2.5% inflation rate, much to the satisfaction of those who believe high rates are necessary to keep inflation in check. However, the longer-term rate also reflects, to at least some degree, optimism, in fact considerable optimism, about the longer-term strength in the U.S. economy. And that optimism is a view we share. That's it for this week. Thanks.